All right, so we'll go ahead and get started. So today we're going to go over areas of interest, people call them points of interest, price delivery arrays, reference points, whatever you're going to call it, whatever. It's all the same thing, and it's basically kind of like the first part to executing a trade. So we have our criteria, and then we have our execution. So with smart money, the biggest difference between smart money is you have kind of like a two-part entry model to a trade. A lot of other strategies, you just wait for 2 or 3 confluences to be happening at the same time, and then you just buy or sell. In smart money, you wait for an area for those confluences to happen. I think that's one of the biggest differences between price action trading and other styles is that it's a two-part setup. So not only are we needing multiple confluences, such as liquidity being taken or structure switch shifting in our direction, but we also need that to happen in a certain area. So the main areas that we want to talk about today are going to be order blocks, and a lot of people rename these as supply zones or demand zones. And I've used that term before, so some of you guys are like, oh, you've said that, but really what it comes down to, it's much more beneficial to understand order block theory because it gives you a genuine look under the hood at what's going on, and you're going to be able to execute more confidently whenever you're thinking from that perspective. The next one I want to go over is breaker blocks. Some of you may have watched a video the other day that I put up about these. And then we have fair value gaps. Now, there are other points of interest in terms of, there's mitigation blocks, propulsion blocks, vacuum blocks. There's volume imbalances, which we're going to kind of go over all those in fair value gaps. And then balanced price ranges, which we just looked at a second ago, is an area where we have 2 fair value gaps, so to speak. So an example of a balanced price range would be something like this. So price move through on the offer and sell side and then rush through on the offer and buy side. So if price is still bullish, you should see a reaction somewhat like this right to the next area of liquidity, which a great example there. But these are the main 3 types of interest areas we're going to look at today. So the first one we're going to go over is order blocks. And some of this for you guys, you may already get this. That's fine if you do. But I'm sure that even if you do understand order blocks, you're going to be able to take something away from this. So we had a class recently that was called Redefining the Order Block that we talked about using different criteria for order blocks. So first off, what is an order block? So the order block is the last move of manipulation before an expansion. And this is a very crude way to explain it. But I want you to just think of the order block like that. So whenever price is coming down, and we come into maybe an old area, maybe an area of liquidity, it's just a reference point, an area of interest, if you will. We come out and engulf. So this whole down move, usually the entire down move is going to be considered an order block. Now, on different time frames, it's going to look different. On the daily, it might be 1 candle. On the 4 hour, it might be 3 candles. On the 1 hour, it might be a bunch of candles. But the idea of an order block is just a big move down to manipulate traders in order to generate liquidity to then push price back up. So, if smart money wants to get long, they're going to have to create sellers. So let's say they sell a ton through this leg down. And once price pushes back up, they bought the liquidity under here and all the liquidity generated from that leg in price. And once they buy, let's just say they have those positions that are short to just generate liquidity, and these are not intended to profit or generate profit, I should say. And then they get in the true move, which is the longs. So this is what you call institutions being net long, so to speak. So if the order block is indeed an order block, you don't want to see price whenever it returns to it. Let's say if they traded for within this level, coming out after they bought up all the liquidity, in reality it would look something like this. They'd have buys all throughout because an algorithm doing it. But once price pushes down, enough sellers are available. Those sellers are then utilized and smart money buys, and price expands rapidly. So if they are underwater on this position and price is moving rapidly up, and let's say this was targeting another area of liquidity up in this region. So once they hit their target on their buys, they're net long all the way up here. And they've made, quintuple the amount in longs on profits than they lost on shorts. And these shorts are just underwater now. This didn't really have a stop loss, so to speak. They just entered this trade in order to manipulate price down so then they could get in their real move. But banks are not in the business of losing money. So what's going to happen is mitigation. So a lot of people use that term and have no idea what it means. Mitigation means exactly that. They're going to mitigate their losses, right? So they don't want to lose money if they don't have to. This was just to manipulate traders. So once price comes back down into the order block, if it is a valid order block and the intention is still to go higher, you should see a rapid expansion away from it. Why? Because they're closing those shorts. So if large shorts are being closed, that is going to be the equivalent of a buy. And it's not like some guy sitting in a suit and tie doing all this. Of course, it's usually algorithmically manipulated. But once we see price move to this order block, if the bias is still bullish, we should see bullish structures signifying that there has been an influx of demand into the market. And that's where people get demand zones. But in all actuality, that's what an order block actually is. It's not, necessarily they're going to be buying in the same exact spots, which theoretically and technically they are, but it's more or less closing sells in those same exact spots. So if we know an order block is the full down move before we have an expansion, we're going to use that hold down range. We're not going to just use one candle unless you go up in time frames to where that becomes one candle. So for example, let's look right here at this order block. When price we went down, took out some internal liquidity. Is that one candle on the 1 hour? Looks a little different, right? What about the 4 hour? Looks different. So the ways you can do this is you could go in and say, okay, well, I'm going to use this whole range, because remember, the hold down move is what you're looking at as an order block. And a lot of people say, oh, well, it has to be one candle. And this is where people get confused, because price is fractal, so you're going to be seeing different perspectives through different time frames. So just because there was a move that had manipulation to the downside on a daily that was one candle, doesn't mean it's going to be one candle on other time frames. Now, order blocks don't necessarily have to immediately break structure, like a demand zone mapping. What is that on my mouse? Keeps doing that. But demand zone mapping, you want to immediately break structure. But for instance, in this example, price comes down, takes out a low, we form an order block right here. Now, this is where you can be a little more aggressive once you understand bias, is because if you are bullish and you have already, established that, we've already talked about market structure and liquidity, but you've already used liquidity and market structure to say we're likely going to a premium, because right here you have that short-term high shift, or if you use this right here, so that's telling you price is going up. So anytime we take out a low, you're looking at it as a buying opportunity. So we don't necessarily have to take structure before we look at that as a buying opportunity. So if we are in a bullish market and you're confident in that, and we have not met our liquidity targets, right, which would have been here, because we had equal highs and a premium, then every time we take out liquidity to the downside, we should be looking for reference points to get active in the market to go to the upside. And this is what comes with being confident in the direction that you're looking for, not looking at structure without context of liquidity, and not looking at liquidity without context of structure. So once we have established we're bullish, we look at any down close candle that gets engulfed as an order block. Now, how can we raise the probability that these order blocks will see a reaction? And that goes back to the class we had on redefining the order block. So a strategy that I've been using a lot, and it's extremely, extremely consistent, and it also works with finding reversals, is waiting for a candle that closes under liquidity. Now, does that have to be major liquidity, like external range liquidity? No. It can be any candle that is by definition a high or a low. So any candle that has a candle on either side of it that has two lower highs, if you're looking for a high, or any candle that has two lower or higher lows. So in this example, we have some internal structure right here. Price comes down and closes below it. Now, if you're not looking at price in the context of the range, in the context of structure and liquidity, you're going to look at this as a displacement breakdown, and you're going to look to short here. Right? And this is where, basic, simple, smart, or supply and demand doesn't work that well. Because you'll say, okay, well, price was at this order block at equilibrium. We got to choke, and then what happens? You get blasted. And it's just simply not understanding ranges and not understanding that price still has a reason to go up. So instead of looking at that as a break of structure and trying to short this order block right here, you look at that as a buying opportunity, especially once it's been engulfed. And you can see price came back down into it, right? So, after price came back down into it, what would you have done then? Well, you can use structure to identify, is what I'm looking for happening. So then you look for bullish price action. So what is bullish price action? It's going to be lows getting taken out and immediate expansions, right? So for instance, what happens here? If we're looking in this range, what's happening? We're seeing lows taken out, short-term highs are taken, price is consolidating, lows taken out, all of that clapped, pushes up, this is taken too, and we start to see this bullish price action. So that's going to help you be bullish on your bias. Now, it's not to say you're going to long every, change of character and swing for the fences. ES is a tough beast to long, but in that example, you're looking at that order block as a reference point for bullish order flow. And once you start to see bullish order flow in the lower time frames inside that reference point, that's the two-step system to really getting a confident bias. So order blocks are going to be those last down pushes that get engulfed in a bullish market, this goes inverse for anybody who's asking for bearish examples. Usually I'm not one to give a bunch of examples on like a bullish side and a bearish side, because I want you guys to get familiar that it's the same thing, right? We're playing a numbers game. All numbers have an inverse, except 0, of course. But we are looking at it from the perspective not of a bull or a bear, but of what's going on in the market. So in order to do that effectively, you have to be able to flip your perspective very easily. So I want you to look at things that I'm going over in a bullish sense the same way you would like to have in a bearish sense. So once price comes down and takes out that low and closes under it, that becomes a much higher value order block. Now, this is a little bit more of an advanced strategy, and it may take some time getting used to. Sometimes it's easier to just trade order blocks before that have an imbalance. And that leads into the next type or confluence you can use an order block, is seeing an imbalance afterwards, right? So that really will show you that there is a strong displacement coming out of this down move. So that down move was definitely just manipulation. When we get that much of a shifted structure, we leave a fair value gap, price travels into it, engineering more liquidity, and then what happens? Take out the sell side into a price delivery array, which is this order block, expansion down into we take out the buy side up here, expansion down into the sell side. So after price takes sell side right here into a price delivery array, what do we look for? Especially when it's these clean equal highs. We're going to look for the buy side. So this is whenever you're combining your structural bias based on premium and discount, that we think price is going to go higher. Yes, we're in a bearish range, but we're looking for price to go higher. Why? Because the displacement's telling us higher. So when we have these consolidations in a bullish market and we get an expansion out of them and we're bullish, this is when we look for power of 3. So just like we caught the power of 3 longs on Bitcoin, it's the same thing, right? We're looking for price to go higher because we're looking at this high. We saw a consolidation. Guess what we came down into? Right into this down candle, and there's actually a unicorn pattern, which I'll get into in a second. We're going to use this as an example. But I'm going to go back to yes. But when we're looking at price and the correct bias, we don't look at this as, okay, it's distributing and we're going to go down to new lows. We look at it as it's distributing to go back down to reference points to take out sell side, because we took buy side, then we take sell side into a reference point. This is what's very important. When you take sell side to a reference point, especially like an order block, this can be order block, fair value gap, breaker block, whatever. Right? We take it out, and then price starts to give us that bullish order flow, and continuously we seek out liquidity. So one thing I want you to understand is that we build our bias based off of our structural reasoning and displacement. That's for me, that is the biggest part of bias. And obviously we're going to see what type of order flow is being respected. We're going to see what kind of liquidity is obvious, but structure is going to be paramount, and that's everything in price action trading. So, once we are looking at the market in the correct way, we're using areas of interest as stepping stones on how to get to where we think the market's going. So you formulate your bias, and then these areas of interest you just use in order to kind of find your path. So for instance, we see an order block, we traded an order block. What happens then? Price comes up, shifts up, what does it leave behind? Fair value gap, right? Then what happens? Price comes up, moves down, doesn't really give us much, but then what? Balanced price range. And you can see that price is consistently drawing towards something, and you're just looking at the stepping stones to get there. And once you tap a stepping stone and you get low time frame displacement up, you're bullish until you take out some kind of liquidity or you hit some other price delivery rate. So in this example, we tapped right here. And let's just say you were bullish from right here all the way to here. You looked for longs this day, you probably won. This day you won. This day you won. You lost here. 1, 1, 1. Pretty good odds if you ask me. So once you develop